Today we're going to go over conventional loans. Last week we covered FHA and VA and HomePath. Conventional loans are loans that are overseen by Fannie Mae and Freddie Mac. Okay, conventional loans typically offer more programs, obviously, than FHA and VA, more terms, more types of loans. Conventional loans really encompass all range of loans from fixed rates to adjustables. The one thing that we need to talk about with conventional loans, the most important thing to talk about with conventional loans is mortgage insurance. Okay, conventional loan used to be, if you had 20% down, you go a conventional loan. That's it. It's the simplest way to get a loan. It's the the fewest restrictions, everything like that. The minimum down payment on a conventional loan is 5% though. Okay, now unlike FHA or VA, the 5% down has to be the borrower's own funds. Okay, now the funds can be borrowed from the borrower's own 401k or retirement plan. Okay, that's one way to get around that. Okay, so if a lot of companies will allow you to borrow off a 401k to buy a home. And that's always a good avenue to explore if your borrowers are struggling with 5% down. Okay, they may have a pretty good funded 401k, and I would encourage them to talk with their employer about any type of home buying opportunities they might have, because a lot of times you can get your down payment through your 401k, and then you pay yourself back. Okay, it's a good way to get a down payment.
There's not a huge penalty that goes with that?
There's not a penalty if you borrow it, because you're not really taking withdrawal.
Gotcha, yeah.
So yeah, you do not have to pay a penalty on that. Okay,
and
you're paying yourself back because it's your own money. I don't have to count those payments against you in your debt to income ratio. So it's a good way.
Maximum loan amount 417. Does that mean above that is a jumbo?
Is a jumbo.
But is that just you? Because doesn't different institutions have different amounts?
Now, Fannie Mae and Freddie Mac set the loan limits, and the loan limit is $417,000. You can go above that, obviously, but then you do get into jumbos, and jumbos are a whole other animal. There's a lot of different guidelines.
I thought at one time, like CapFed, I know that they've reduced it, but they had maybe a higher amount than, no?
Well, CapFed is not governed by Fannie Mae and Freddie Mac on their loans. Okay. CapFed typically does portfolio loans, which means they set their own underwriting guidelines. Okay? I'm talking about strictly loans that are underwritten by, or fall under the umbrella of Fannie Mae and Freddie Mac.
But everybody understands what a portfolio loan is, do they?
A portfolio loan, is basically going to be a loan where the bank is going to come up with their own lending terms, okay, and underwriting guidelines, which may be a little more lenient than what Fannie Mae and Freddie Mac is. But what you get with them is you get the rates, you get the programs. If you go to the local bank and you've got something outside the box, you probably won't be able to borrow for a fixed term, maybe a 3-year term, or maybe at the most a 5-year term. Okay, those type of programs are out there on a limited basis. Okay, but you're not going to be able to borrow with the flexibility you will under Fannie Mae and Freddie Mac. Okay.
And when you portfolio loan, a lot of times it means it's not sold on the open market, so that they keep it in-house and they service it in-house, so it doesn't meet the requirements of Fannie Mae and Freddie Mac sometimes, so that if they couldn't even try it, they couldn't sell it on the open market to Fannie Mae or Freddie Mac because it doesn't meet their guidelines.
And typically banks don't want to keep portfolio loans on their books for an extended period of time. That's why they'll offer shorter terms.
Except CapFed.
Right.
Yeah. They only do. CapFed doesn't sell
more like a little card loan or something.
No, they do.
CapFed did.
No, they do a lot of mortgage
They do
loans.
that. Then.
Yep.
Yeah, as of recently though, I don't know if CapFed is as aggressive with their pricing, that kind of stuff, as Fannie Mae and Freddie Mac are going to be. So typically, if you've got a good borrower, a solid borrower, you're going to get the best rate for your client through a Fannie Mae or Freddie Mac institution. Okay. Like I said, the minimum down payment is 5% of the borrower's own funds, 20% down to avoid mortgage insurance. Now there's a whole wide range there between obviously 5 and 20% down. Okay, and that's where the flexibility of conventional loans comes into play. Understand that the more you put down on a conventional loan, between 5 and 20%, the less the mortgage insurance is going to be. Okay? Mortgage insurance is really the wild card when it comes to conventional mortgage. Finding the right mortgage insurance program for your buyers is as important, if not more important, than finding them the best rate. Okay, and the reason I say that is because, let's say on a $200,000 purchase, you can go out and shop and find mortgage insurance, and you don't really do that, it's something I do, but find mortgage insurance for your client that can cost $200 a month, okay, just for example. Or I can go out and shop and find a mortgage insurance program that doesn't have any monthly premium, okay, it's a significant difference. You can really talk to your clients into more house if they don't have a $200 mortgage insurance premium.
Sure.
I mean, the difference between that, instead of buying $200,000, they get the same payment for buying $250,000. Okay, so mortgage insurance is key. Okay, and finding the right mortgage insurance program, like I said, is very important. Now, there's several criteria that go into determining what mortgage insurance is. First of all, does everybody know what mortgage insurance is I'm talking about? Okay, there's several. There's a lot of criteria that goes into it. Down payment, credit score, loan term. The better credit score you have, the cheaper the mortgage insurance is going to be. Think about it like car insurance. You know, the fewer accidents you have, the better premium you're going to get. Okay, so the more solid of a borrower you are, the better your mortgage insurance, cheaper your mortgage insurance is going to be. Okay, loan term. The shorter the loan term, the cheaper the mortgage insurance. Okay, which I know some people don't really don't necessarily equate to being, you know, a cheaper mortgage insurance. But if you have a 15-year loan, you're going to have a lot cheaper mortgage insurance. Okay. Let's see here. I do that. I know I get right into mortgage insurance because it is such a crucial role with conventional mortgages. But getting back to some of the nuts and bolts of conventional mortgages, FHA, the closing costs are 6%. For conventional loans, it's 3% of the loan amount. Okay. Like I said, there's flexible loan terms on conventional loans. Conventional loans right now, 5-1, 7-1 ARMs are becoming more and more popular. You can get, 3/4 lower on the rates if you've got a client that maybe isn't planning on staying in the house for a significant period of time. They want to get the best payment possible. Maybe a 5 or a 7-year ARM will fit your borrower's needs. Okay. Also, you can go with shorter terms. Like I said, you can go with terms in 5-year increments. 35-year, 20, 25, 20, 15, 10. Any term your borrower really wants, whatever fits their needs. If somebody comes to you, is in their mid-50s, say, we're going to buy this house, but I don't want a house payment after I retire at 65. Then we will be able to look at a 55 or a 15-year or a 10-year note. Okay. Like I said, there's tremendous flexibility. I think conventional loans are really starting to make a bit of a comeback after FHA really dominated the market for the last couple of years. And I think that's really attributed to a couple different things. First of all, FHA has raised their mortgage insurance premiums, or monthly mortgage insurance that you pay, 3 times in the last 18 months. Okay, so it's significantly more expensive now than it was, let's say, a year and a half ago. Okay, conventional loans and private mortgage insurance companies are really the companies that got beat up the worst and really continue to get beat up from the housing decline. Okay, and because of that, they really kind of went into a shell, and it was really difficult to get mortgage insurance for these loans. They're starting to get back in the game a little bit. Okay, what I've seen, they used to just hate every appraisal they came across their desk. Now mortgage insurance companies are starting to be a little more loose. Okay, so it's definitely more of a viable option. Okay, depending on the credit risk of your borrower. FHA is still going to be king for lower credit scores. Below 680 is going to be FHA still. Okay. One thing that's not on this sheet that I know Brad wanted me to cover is 80-10-10 loans and 80-15-5 loans, those kind of things. If you have 10% down, under certain circumstances, you can avoid mortgage insurance by getting 2 separate mortgages. Okay, what you do is you get an 80%, say you have a $100,000 purchase.